back with Achilles Financial, and we are back with another day in the stock market. And in particular, what I want to do today is highlight what you can do if you have a trade that goes against you or goes the wrong way, or you went in at the wrong time. So that being said, my moves today, for those of you who just want the plays, I did a covered call on Bank of America for next week, sold that for $20 at for a $29 call. I went all in on my DHI calls. That's DR Horton. They're a home builder. We do have the home builders confidence that came out today, and it was very good, very positive. And we have new home starts tomorrow morning. That's what I'm looking to trade. I do intend to trade this tomorrow. So those are the ones. And then I also have the FTAI calls. That is based off of the news of the infrastructure bill. So those are the plays today. And now to get a little bit more in depth, we're going to be diving into the SPY trade that I made, which is this is the strategy that you can utilize if you find yourself in a trade and you either A, don't want to day trade it, or B, you think that your probability of making a lot of money on the trade is going away and you want to hedge the bet. So you still want to stay in the trade, but you still want to you get some money back. So the way that I do that is I will use a debit spread, also what's known as essentially you are paying to stay in the trade. So if we look at the S&P 500 ETF or SPY, the most popular ETF on Robinhood, if not the most popular ETF out there, you see that we had a big dip today at 11 a.m. Now, generally speaking, 11 a.m. is a big time point for the market because generally speaking, and this can be mitigated by the fact that we have a lot of volatility right now, but generally speaking, we'll see that that is the general trend of the market if we can see those moves in the first 2.5 hours of the day. So once I saw that the market was really dropping and dropping pretty quickly at this point, I mean, you can see that from really 10:50 to 11 o'clock, we dropped nearly 400 points. That being said, I said I wanted to make a put play. So what I did is I did what maybe some of you have done in the past, and what I have definitely done is I bought with the momentum and it bottomed out. So I don't know if it was right at 309. I think it was like 310 when I made this trade, but I did get a buy for a put on $298 by the end of the week. Now what I noticed is I said, hey, after this bounce up, I was like, okay, we should be okay. And it bounced down, bounced up. I was like, okay, we may be trending differently. And it kind of leveled out and didn't show any momentum downwards. Now, I recognize that we did have a huge swing downwards last Thursday. So I thought, it doesn't make sense to just totally get rid of this play. But at the same time, I'm still bullish on the market, still bullish on the economic data coming out. And we could also see ourselves at 120. And I paid a hefty premium on this put right here, which is like 168. Yeah, so I'm already down nearly half the play here. And I said, okay, how can I get out a little bit unscathed? So what you can do is you can go into the options, and if I'm looking at what I purchased, you'll see that that will come up down below. So I can see my little +1. I am in the wrong date now. You can see my +1 down here below for the trades that I've made. So I've got my +1 and then the one that I've sold. Anytime that you're making a trade, whether it's on the call side or on the put side, what you can do is you can either sell a call above it or you can sell a put below what you played. So here what I was able to do is I now have a $298 put that I purchased, and then right on the back end of it I was able to sell this for $71. I've got a $297 put that I can play here. So what does that look like in practice? If I go into the S&P 500 ticker, I can now see my options plays here. So yes, it says that I am missing out on 90% return or minus 90%. What that's actually doing is the return on the difference between these two plays right here. So this does not actually mean that I'm down 90% of my total investment. However, it's still not pretty. But what I've done here is I've guaranteed that I got that $71 from this trade, even though I lost money from here. So let's go into a different chart that shows kind of the difference in that risk mitigation that we could see. So as you can see here, I am on the options profit calculator that I like to use. And I've got the trade that I made today if it was just the put play that I did. So this is what I purchased for it. And now if I scroll down, you can see a lot of the different ways in which I lose on this trade. So the worst part about this is even here, we're seeing that I'm not actually making money because this was essentially today. So I wasn't able to capture any of this, even though it did, or I basically bought in at the high price. So tomorrow I'm looking and I'm saying, hey, it doesn't look good, even if we bounce down, or even worse, what if we bounce up? I'm still going to be in trouble. So instead of being in a worst case scenario, I could lose $168, where in a best case scenario, I need this to finish all the way down here, or we really need to drop below, for me tomorrow, we need to drop below 309 for me to see any form of profit. What I did instead is I did this spread play. So this mitigates my risk. Now you can see that I've also lost a lot of the potential profit here, but what I mainly did is I mitigated the risk. So we went from losing $168 here. You can see losing 168 on this wide swath of the chart right here, to now the maximum I can lose is $97. So what this is doing is essentially giving me back $60 to $70 just because I made that sell. And yes, it could drop below, but I am more so thinking that we're going to go this direction. And in a best case scenario, if it does drop and I make the sell, I will take advantage of the profit here, and I am okay with a $4 profit, with a $37 profit. Every options trade you make does not necessarily have to be the 1000% return. So all that being said, one of the key things that you can do here is if you find yourself looking at a chart and realizing, hey, I may have just been momentum trading, I may have made a bad trade, and I want to have an exit strategy, but either you are not able to use day trades or you still think that there's potential for a profit in the trade, what I would recommend doing is either selling a call, if it's on the call side, outside of what you did, or B, selling a put outside of your put play. So you're developing a debit spread, and this is easy to do. So anytime that you have options trading enabled, if I were to make this trade for the end of the week for a call perspective, as you can see here, I'm buying one and I am selling the other, and this is a call debit spread. You can see that right here. I now have a cost of $25. So the way that this gets really interesting is when you're making these trades having already done one side of the debit spread. So this is just an easy way that you can still regain a little bit of money, and what you'll see is that cash balance will show up right here in the buying power section here. So you'll have that cash readily available if you find yourself making another trade. It's still capable of helping you out. What I don't want you to do is use this as a panic button every single time, but you're okay to press it once or twice. So this is what I would recommend if you find yourself locked into trades that you think are difficult or not realistically going to happen. But there's a lot of opportunity here, and I hope you're able to use this. So if you found this content helpful, please leave a like and subscribe. Thanks everyone. Talk to you later.